योगः कर्मसु कौशलम्.
Hello friends, I am Professor Fahmida Sheikh, Gujarat College, Gujarat University. Today we will discuss the concept of management accounting, meaning, nature and objectives. Friends, today we will start to understand terms management accounting thoroughly. Finance and accounting have gained much importance in today's competitive world of business. The accounting function has become significant part of firm's management information system. Enterprises are facing more challenges and opportunities than the past. Changing business practices have redefined the role of accounting. Management accounting is one of the accounting branch which is useful for evaluation of business performance and decision making for optimum utilization of existing resources. Today, we are going to discuss the concept of management accounting. Friends, our discussion on management accounting will cover number 1, branches of accounting, second, meaning and limitations of financial accounting, third, meaning and limitations of cost accounting, fourth, evaluation of management accounting, fifth, meaning of management accounting, sixth, nature of management accounting, seventh, objectives of management accounting. Now let us see branches of accounting. Accounting can be classified into following categories. Number 1, financial accounting. The main purpose of this type of accounting is to record business transaction in the books of accounts in such a way that operating results for a particular period and financial positions on a particular date can be known. Second, cost accounting. It relates to the collections and classification cost data from financial informations and ascertainment of cost of one unit of good manufactured or one unit of service rendered. Example, cost per car manufactured, cost per unit of electricity generated. Cost accounting is helpful in determining cost per unit, determining selling price per unit, exercising control over cost and eliminating unnecessary expenses. Third, management accounting. It relates to the use of data of financial and cost accounting for the purpose of analysis of financial performance for policy formulation, planning, control and decision making by the management. The accounting which is prepared exclusively for the use of management is called management accounting. Meaning and limitations of financial accounting. Let us first go to the history of financial accounting. Financial accounting is the oldest branch of accounting. Generally, in the accounting history, it is believed that the double entry system of accounting formally started with Luca Pacioli's book in 1494. He is believed as father of modern double entry bookkeeping. As you all know that financial accounting is the process of identifying financial transactions, measuring them in terms of money value, recording them, classifying, summarizing, interpreting and analyzing the result and communicating accounting information to various users. As per American Institute of Certified Public Accounts, accounting is the art of recording, classifying and summarizing in a significant manner and in terms of money, transaction and event which are in part at least of a financial character and interpreting the results himself. The main function of financial accounting are number 1, maintaining systematic records, number 2, preparing financial statements and number 3, communicating the financial results. Though financial accounting is inevitable to know financial results and financial position of the business, it has certain limitations which lead to evaluation of cost accounting and management accounting. The limitation of financial accounting are: number 1, no detailed informations about cost. Financial accounting provide information as a whole in terms of income, expenses, assets and liabilities. It does not provide detail of cost involved by departments, processes, products, services or other unit of activity within the organization. Second, no cost control method. It does not have proper mechanism to control expenditure on various elements of cost like material and labor. As a result, misappropriation, wastage and losses of materials are left unchecked. Proper utilization of labor becomes impossible and suitability of different labor incentive plans goes without evaluation. Third, no information on efficiency. It does not have any system to judge the efficiency in the use of material, labor and overhead cost of the organization in comparison to the standard fixed for their use. Number 4, no classification of expenses. It does not classify expenses as direct and indirect or fixed and variable. Besides this, are also not allocated to different stages of productions or department or processes to show the controllable and uncontrollable items of overheads. Fifth, historical in nature. It is prepared at the end of the accounting period. It fails to provide insight about future. Sixth, not helpful in price fixation. It does not provide adequate cost information to fix up the price of products manufactured and service rendered by the organization. Seventh, no analysis of losses. It does not provide detailed information about the reasons of losses. It also does not help to determine the variations in the cost between different working times, idle time and seasonal conditions of the industry. Eighth, no cause and effect analysis. As financial account fails to provide profit and loss information product wise, the causes of profit or loss cannot effectively determined and analyzed. Meaning and limitations of cost accounting. Now let us discuss in brief the other branches of accounting, that is cost accounting. Prior to the Industrial Revolution, business were small and characterized by simple market exchanges between individuals and organizations. In those times, there was a need of accurate bookkeeping, though not that much of cost accounting. However, the Industrial Revolution in the 18th century, large size process industries performing single activities, example textiles, railways, etc., came into existence. During this period, there was a lack of market for intermediary products, because of which cost information gained importance as a tool for measuring efficiency of different processes. Scholars believe that practice of cost accounting evolved during Industrial Revolution, which took place during late 1700 and early 1800s. Cost accounting is developed to overcome the limitations of financial accounting, and it helps in calculating, controlling and reducing cost. Chartered Institute of Management Accountants defines cost accountancy as the application of costing and cost accounting principles, methods and techniques to the science, arts and practice of cost control and the ascertainment of profitability as well as presentation of information for the purpose of managerial decision making. Cost accountancy is the application of accounting and costing principles, methods and techniques in the ascertainment of costs and the analysis of cost as compared with previous experience or with standards. The main function of cost accounting are to ascertain the cost per unit of production, to help in determining the selling price, to help in cost control and cost reduction, to ascertain the cost and profitability of each division, unit, activity, center, etc., and to assist the management in decision making. In spite of much better usefulness of cost accounting compared to financial accounting, the cost accounting has its own limitations, like it presents the base for taking the best decision, but it does not give outright solutions to the problem. Cost varies with purpose. Therefore, cost called for a certain purpose will not be suitable for other purposes. Cost accounting is not an exact science. It involves inherent element of judgment. It lacks a uniform procedure. A suitable system is to be devised for each individual concerned, and it would be a time consuming and expensive. Most of cost accounting techniques are based on some presumed notions. Different views are held for inclusion of certain items of cost in ascertainment of total cost. Evaluation of management accounting, it has roots in the managerial accounting industrial revolution of the 19th century. During this early period, most firms were tightly controlled by a few owner managers who managed to raise funds on personal relationships and their personal assets. Since there were no external shareholders and little unsecured debt, there was little need for elaborate financial reports. During this period, managerial accounting was relatively sophisticated and provided the essential information needed to manage the large scale productions of textile, steel and other products. Many firms needed to raise funds from increasingly widespread and detached supplier of capital. To tap these vast reservoirs of outside capital, firms managers has to supply audited financial reports. Because outside suppliers of capital relied on audited financial statements, independent accountants had a keen interest in establishing well-defined procedures for corporate financial reporting. In the early part of the century, as product line expanded, operations become more complex, companies felt need for management-oriented reports separate from financial reports. This requirement of separate managerial report gave rise to practices of management accounting. Let us summarize the evaluation of management accounting. In the year 1812 to 1920, accounting for processes prior to the matching concept focus on operating cost and efficiency of processes. In the year 1920 till 1950, cost accounting matching concepts developed focused on cost determination and financial control. In the year 1951 to 1980s, managerial accounting focus shifted to providing information for management planning and control. 1980. In the year 1980s, cost management focus shifted to the reduction of waste, just in time, teamwork, target costing, total quality management, investment and product life cycle management. In the year 1990, value-based management focus shifted to include the creation of customer value, strategy, balanced scorecard, economic value added and other related concepts. According to Chandler 1977, management accounting system first appeared in the United States during the 19th century. This management accounting system employed both simple and complicated accounting methods. Cost accounts were used to determine the direct labor and overhead cost of converting raw materials into goods. The use of sophisticated accounting procedure also date back to the 19th century. Following innovations in the field of strategy and operation management have influenced management accounting system and practices over the past several decades. During the last 2 decades of the 20th century, many companies implemented just-in-time program designed to minimize the amount of inventory on hand. Meaning of management accounting. We discussed the management accounting practices developed from requirement of separate managerial report and practice of just-in-time and total quality management. Now let us discuss the concept of management accounting in modern times. Today, Management accounting is an indispensable discipline for corporate management, as the information based on financial accounts and cost accounts are collected and presented to management, and management accounting techniques are applied to help the management to solve not only specific problems but also guide them in decision making. Management accounting can be viewed as management oriented accounting. It refers how the accounting function can be reoriented so as to fit it within the framework of management activity. The primary task of management accounting is to redesign the entire accounting system so that it may serve the operational need of the firm. It is the study of managerial aspect of financial accounting. Accounting in relation to management function, it is the accounting for effective management. The financial data are so devised and systematically development that they become a unique tool for management decision. Management accounting collects and provides accounting, cost accounting, economic and statistical informations to the man at various managerial levels to assist them in the performance of managerial functions and their evaluations. It is closely related with the development and application of various techniques of recording, analysis, interpretations and presentations, making the financial, costing and other data in the performance of managerial functions like planning, decision making and control. It should be noted that management accounting make use of not only accounting techniques but also statistical and mathematical techniques. As per American Accounting Association, management accounting includes the methods and concepts necessary for effective planning, for choosing among alternatives business actions and for control through the evaluations and interpretations of performances. According to Charter Institute of Management Accountants, management accounting is the process of identification, measurement, accumulation, analysis, preparation, interpretation and communication of information used by management to plan, evaluate and control within an entity and to assure appropriate use of and accountability for its resources. Management accounting also comprises with the preparation of financial reports for non-management groups such as shareholders, creditors, regulatory agencies and tax authorities. The Institute of Management Accountant recently updated its definition as follows. Management accounting is a profession that involves partnering in management decision making, devising planning and performance management system and providing expertise in financial reporting and control to assist management in the formulation and implementation of organization strategy. The American Institute of Certified Public Accountants states that management accounting as practice extends to three areas such as strategic management, advancing the role of management accountant as a strategic partner in the organization, performance management, developing the practice of business decision making and managing the performance of the organization, risk management, contributing to frameworks and practices for identifying, measuring, managing and reporting risk to the achievement of the objectives of the organization. The Institute of Certified Management Accountants states a management accountant applies his and her professional knowledge and skill in the preparation and presentation of financial and other decision oriented information in such a way as to assist management in the formulation of policies and in the planning and control of the operations of the undertaking. Management accounting is comprised of two words, management and accounting. It means the study of managerial aspects of accounting. All the definitions given above by renowned organization illustrated clearly the crucial role that management accounting plays as a multi-level decision support system in which the effective information was submitted to managerial personnel to plan, control, organize and make decisions to achieve business goals. Management accounting helps in preparing internal financial reports, records, and accounts to assist in the decision making process for the company's internal stakeholders, not for the external stakeholders. It is the act of making sense of financial and costing data and translating that data into useful information for management of an organization. It is redesigned version of accounting to be helpful to the management in formation of policy, control of execution, and appreciation of effectiveness. It is concerned with providing information to management in an organization to enable them to carry out their planning, controlling, and decision making responsibility. This also helps the manager to discharge the duties more efficiently and effectively. Management accountants are known as the value creators as they are much more interested in forward looking and taking decisions that will affect the future of the organization than in the historical recording. Nature of management accounting. We can consider certain aspects as the nature of management accounting. Management accounting is a decision making system. Management accounting provides accounting information in such a way as to assist management in the creation of policies and in the day-to-day operations. Though management accountant is not taking any decision but provides data which is helpful to management in decision making. It communicates a great variety of facts in a systematic and meaningful manner. Information supplier. Management accounting caters cost and financial data informations to all levels of management of organization as per their requirements. It is supposed to the organization to take fair decision to achieve its target. Moreover, the information provided also helps to review and to compare targets as per planning. It also shows information for day-to-day operations of the undertaking. It is the act of making sense of financial and costing data and translating that data into fruitful information for management of the organization. It provides detailed analytical data of specific activity or product or division to facilitate better planning and control functions. Managerial accounting analyzed and used by business leaders to take decisions and run the company more effectively. Managerial accountants handled many facets of accounting as per their competencies. Forward looking. Basically, by the nature, management accounting is forward looking and proactive. It supplies information for present and provide information for future needs of management. Management of organization pursues challenges ahead in the way. At this point of time, management accounting serves as a forecaster. It provides information to management not for planning but also for future decision making. No fixed norms. In management accounting, no set of rules or standards are to be rightly followed like financial accounting. The required information is provided by accountants in a manner as it suits the management of organization. Thus, the format and method of presentation of information is subjective. It is differently reflected in companies' internal reports. Emphasis on cause and effect analysis. Management accounting studied and analyzed the cause and effect of results unlike financial accounting and cost accounting. Financial accounting represents financial results of a particular period. For example, profit and loss account does not reflect reason of profit or loss during particular period. The cause and effect of profit or loss incurred are probed and the factors directly influencing the profitability are also studied. Increases efficiency. The purpose of using accounting information is to increase efficiency of the concern. It acts as vehicle for enhancing the working efficiency of the organization. Management accounting uses the accounting information in formatting plans and setting up objectives. Comparing actual performance with targeted figure will give us an idea to the management about the performance of various departments and cost centers. When there are deviations, corrective measures can be taken at once with the help of techniques such as budgetary control and standard costing for improvements. The process of fixing the targets and achieving the targets leads to the improvement in efficiency. Assist in achieving objectives. Management accounting always assists organization in achieving its predetermined goals. It furnishes information quickly and at comparatively shorter interval as per the requirement of the management. It supports the management of organization through providing the relevant and accurate information at the right time for taking rational decisions to sort out the business uncertainties. It also provides detailed information regarding the weaknesses and strength of the organizations in the form of reports. On the basis of that, any organizations can work on to eliminate its business problems and may achieve its goal easily. Techniques and concepts. Management accounting employs special techniques such as standard costing, marginal costing, budgeting control, project appraisal, etc. to make accounting data for more fruitful to the management. Each of these techniques serves as useful tool for specific purposes in analysis and interpretation of data, establishing control over operations. Internal use orientation. The information provided by management accounting is purely designed and meant for internal use. It provides relevant financial and non-financial information. Management accountant analyzes and interprets the accounting data to suit the informational needs of the management. Thus, management accounting has an internal orientation. Selective. Management accounting is selective as it focuses only on specific information which is relevant for decision making. Only relevant facts and informations are taken into account and others are ignored while taking decisions. Objective of management accounting. Dear students, now let us understand the management accounting precisely by pondering on its objectives. To formulate planning and policy. Management accounting assists top level management in planning the strategy of the business in order to achieve organizational goals. Planning involves focusing on future activities and their executions in a more practical and effective manner. Planning is what need to be done, when and by whom, and how activities are to be done. It involves intelligent future forecasting on the basis of available information, setting goals, framing policies, determining the alternative courses of actions, and deciding activities to be undertaken. Budgetary control is used for the proper execution of the business goals of the organization. Decision making. Decision making refers to select effective one of alternatives available. Success of selection depends on effectiveness of information network. Management accounting provides essential informations and make decision making process more scientific with the help of various modern techniques such as marginal costing, absorptions costing and differential costings are applied for effective decision making. Informations about cost, price and contributions are collected and analyzed of each alternatives. Such analysis provides platform for effective selection. In different situations such as whether to make a product or outsource, whether production should be through technology or labor, whether selling price should be increased or not, etc., management accounting helps in decision making. Analysis and interpretation of financial statement. Management accounting collect, analyze and interpret financial data presented in financial and cost statement. It provides useful information to the management. It presents the information in an intangible and non-technical manner. This will help the management in evaluating alternative courses of action available and helping the management in taking best decisions to achieve the most desired financial results. Thus, one of the major objectives of management accounting involves explaining the financial information in a simple and no technical manner. Common size statements, comparative financial statement, cash flow statement, and ratio analysis tools are applied for analysis and interpretation for translating useful and effective information. Efficient coordination. The analysis and interpretation of modified data is supplied to all levels of management executives. The objective of organizations are achieved through attainment of targets of all the functional departments such as production department, sales department, marketing department and finance department. Budgets are important means of coordination such as cash budget, flexible budget, sales budget and master budget. Management accounting involves preparing budgets for all the departments of the organization and thus helps them fix the target appropriately to achieve. Thus, the preparation of periodical performance report of all the department under management accounting system coordinates all the departments. To provide reports, it prepares the report of performance of activities of all departments of enterprises and evaluates on the basis of the set targets. Managerial reports are prepared exclusively as per requirement of top level management of enterprise and provides on regular basis. Reports are not subject to statutory audit. It keeps the management fully updated about the latest positions of the concern through reporting. To help in control, management accounting plays an important role to the management in assuring the existence of proper management control system. It controls the resources of organization and ensures the effective use of resources through application of various control techniques such as standard costing, responsibility costing, budgetary control and management audit, etc. Management accounting makes use of all the cost data by focusing it towards managerial decision and comparing actual performance with the budgeted, ascertainment of variances and finding out their causes and suggesting corrective actions to achieve predetermined organizational goals. Let us conclude the session. We learned that financial accounting is the oldest branch of accounting, which is mainly concerned with maintaining financial record and presenting financial results and financial position. Cost accounting deals with calculation of cost for the purpose of appraisal of department or a unit or a machine or an individual as regards to cost. The main objective of cost accounting is to exercise control over cost to maximize profit. Management accounting developed from the need of cost accounting. Management accounting deals with presentations of financial and cost data in such a manner so that performance of business can be analyzed for the purpose of decision making for future. We will discuss other aspects of management accounting in next session. Hope you have learned the concept of management accounting. Thank you all.